Good afternoon and welcome to today's session. All lines are on listen-only mode. This call is being recorded and will be posted on the QC website. If you have any objections, please disconnect now. If you have any questions, please enter them in the Q&A box located in the bottom right-hand corner of your screen. If you have joined using a browser other than Chrome or Firefox, please disconnect and join using one of them. Or if you're experiencing any technical difficulties during the session, please use the raise hand icon and someone will assist you. And finally, we invite you to please remain on the line at the conclusion of the session to complete a brief survey. Your feedback is very important to us. With that, I will turn it over to our Director of Single Family Underwriting, Steve Glancy. Steve, the floor is yours.
Thank you. Welcome everyone to Freddie Mac's Let's QC quarterly webinar series. My name is Steve Glancy, and I'm a Director of Quality Control here at Freddie Mac. Pardon me while I start my video. Here with me today are QC managers George Karenchak and Mike Zeman, as well as Susan Wren-Lindeman and Kelly Morocco from our Affordable Credit Policy team. In a few moments, you will get a chance to meet them and hear about their topics. Quickly, a reminder of where this idea began. In 2020, Freddie Mac took a look at our sampling volumes and saw tremendous growth within the community lending segment. We think the historically low interest rates, along with your ability to serve your communities through this pandemic, helped fuel this growth. Rapid growth can also bring challenges, and we noticed an increase in the overall not acceptable quality rate, what Freddie Mac refers to as an NAQ. NAQ is a performance metrics which uses the base random sample loans determined to be defective and resulting in remedy. This metric impacts the seller's base random sample and is also used by Freddie Mac to measure our overall loan quality. So we put this series together to share areas our QC department sees defects in, present scenarios for particularly challenging situations, and include updates from other business areas such as our credit, sales, or policy teams. As we continue to strengthen the relationship with our community lenders, our goals for these Let's QC quarterly calls are to provide training and guidance, allow transparency and insight into our quality control loan review process, and give you useful information to incorporate into your underwriting and QC process. So let's meet the team. So a little background on myself. Minus a brief hiatus after the crash in 2008, I have been in the industry since 2003, and 14 of those 16 years have been in underwriting or QC, with the last 11 spent right here at Freddie Mac in quality control. I will be sharing with you some of the common defects and trends we see in our QC process. George, how about you introduce yourself and your topic?
Thanks, Steve. Good afternoon. My name is George Karenchak, and I've been with Freddie Mac for the last 11 years, with all of that time being spent in quality control. Today, I will be presenting our first loan scenario that focuses on previous adverse credit events. Mike?
Hi, everyone. My name is Mike Zeman. I've been with Freddie Mac for the last 10 years, all of which have also been in quality control. Today, I will be presenting our second loan scenario that focuses on evaluating a borrower's credit for manual underwriting. Susan, you're up.
Thanks, Mike. I'm Susan Wren-Lindeman, and I joined Freddie Mac just 16 months ago as an affordable credit policy manager. I'm passionate about helping serve the underserved community through our work in the affordable policy area and look forward to talking with you today about affordable seconds. Kelly?
Hi, I'm glad to be here today. My name is Kelly Morocco. My entire career has been focused on affordable in the retail market, local government administration, and for the last 5 years at Freddie Mac. I spent my first 2 years on the Duty to Serve team and the most recent 3 years as Director of Affordable Credit and Policy. One of the largest barriers to low-income borrowers is down payment, and Freddie Mac's flexibilities around our affordable seconds have a positive impact on bridging that gap. We look forward to telling you more about it today.
Thanks, everyone. It looks like we've got a lot to cover, so let's get started. So in this series, we will look at defects on loans that resulted in remedy in the prior quarter and break them down by different categories. We'll also identify any trends we see. These defects will be specifically from loans sold to Freddie Mac by our community lending segment. Currently, we're looking at defects for loans Freddie Mac QC closed in the first quarter of 2021 and trending them against defects from loans that Freddie Mac closed in the fourth quarter of 2020. For Q1 2021, we found 448 unique loans with one or more defects from a population of 2,821 performing loans. And while this was a 22% increase in defects from the 366 loans in the prior quarter, it was also in line with a 36% increase in funding volume. The net result was a 2% decrease in the overall defect rate. So in order to highlight areas of focus, we'll only look at individual defect codes that appeared on 5 or more loans.
Hey, Steve, let's remind everyone that similar to their own post-closing QC, most of these loans were originated and closed earlier in 2020. We hope you find this information we share valuable so you can focus your QC efforts within your own organization.
That's a great reminder. Thanks. So let's take a closer look at our top 10 defects. So this chart here shows the top 5 defects on loans closed in Q1 2021. The first one, missing verification of taxes or insurance, is a top defect across all loans. We did increase it from 95 to 123 this quarter. This continues to be a leading defect in QC, and it is related to taxes and insurance on the primary residence or other real estate owned not being validated. As a reminder, just even when Freddie Mac is able to validate it through other sources, we still capture this defect on remedy loans, which also contributes to its higher frequency. The next defect under collateral is appraisal flexibility violation. So we saw a jump in this category as it moved into the second spot. This defect is related to the temporary COVID-19 appraisal flexibilities that were created during the pandemic. We continue to see these predominantly in owner-occupied cash-out refis, and our internal monitoring continue to pick up many of these issues.
Steve, didn't we recently announce the retirement of the appraisal flexibilities?
Yes. On April 21st, in Bulletin 2021-15, we announced the final extension of the temporary appraisal flexibilities that were published in Bulletins 2020-5, -8, and -11. Loans funded after June 1st, 2021 must meet all applicable guide requirements. So our third one is liability docs missing or insufficient. This is usually when a liability disclosed on the app or somewhere else in the file is not properly documented.
Hey, Steve, can you give us some examples here?
Yeah, absolutely. A lot of things we see like alimony and child support, along with student loans, are common ones, the common ones that we see that are not always properly documented, and the payment may not match what is on the credit report or other documentation when used in qualifying. So I also want to point out that the number of defects in this category actually remains steady. And while it's still the third highest defect, this was good news because we saw the number of defects in many other categories across the board spike. So fourth one is insufficient funds. Another category we saw a large jump in during QC reviews closed in the first quarter of 2021.
Hey, Steve, can you remind our listeners of some examples of ineligible funds?
Sure. Some of the ones that we see can be anything from an unsourced large deposit to funds borrowed from an unacceptable source like the builder, or even gifts that are not from a related person as defined in the Freddie Mac glossary.
Steve, I'm not sure everyone knows how Freddie Mac defines related persons. Didn't we just make improvements to the online guide published on our single-family website that could help easily identify this and other terms?
Yes, we did. So now in our online guide, if you see a term underlined with dashes and you hover over it, you'll get a pop-up box with the glossary definition for that term. And the last one that rounds out the top 5 is miscalculated income. It did move down one spot. Combined with income docs missing, you'll see at the top of the next slide, these two continue to exceed all other categories with the exception of the missing taxes and insurance. So a majority of our challenges continue to be in the calculation of hourly and fluctuating income sources for both newly employed and seasoned workers. The most recent wages and hours on a pay stub are typically used. However, we find many borrowers lack the required history to support the level of earnings used to qualify. So we encourage you to pay close attention to this on all loans. What we have found is that small miscalculations can frequently mean big trouble, especially for loans with a DTI ratio in excess of 40%. So let's take a look at the next slide. And here, we just touched on income docs missing on our prior slide. I will note too, this is the only category we saw a decrease in the number of defects. But let's look at the remaining 4. COVID-19 temporary income violation. We did see a large jump in this category as we continue to assess loans under the COVID-19 temporary guidelines. This defect covers issues discovered in both wage earners and self-employed borrowers as they relate to COVID-19 temporary guidance. While the increase was a concern, it is still less than half the number of defects we see regarding income in general. The origination vintage of this population also included more loans that were subject to our more restrictive self-employed guidelines that went into effect on June 11th, 2020. And the last three are related to credit and liabilities, and we'll touch on them real quick. In liabilities, we saw a small jump in this category, and we want to remind everyone that if you exclude a liability, we must see documentation to support that omission. Bankruptcy docs missing. While this defect has generally been on the decline, we did see a small uptick in the number of loans with this defect. Please remember to include bankruptcy documents when required. If a mortgage was involved in the BK, the statement of intention is a critical part of the bankruptcy package that we find frequently missing. And we'll discuss that more in our first scenario. And undisclosed non-mortgage debt. Fraud in general, we mentioned last time, has been on the decline. However, this is our first fraud-related deficiency code to enter the top 10. This is also our top trending fraud defect code in QC. We encourage you to review all credit inquiries and address them with your borrowers prior to closing. So before we move on, let's review some key takeaways. COVID-19 temporary appraisal flexibility violations are still a concern. Defects from inaccurate income calculations and missing documentation continue to lead our industry. Missing assets with its recent uptick, and we wanted to remind you, no cash out refis and debt paid off prior to closing may still require documentation of funds. And lastly, collateral defects outside of COVID-19 temporary guideline violations remain low. Our ACE and loan collateral advisor take-up rates continue to rise. So last quarter, we looked at where we see defects across transactions and occupancy types. And here we discovered temporary COVID-19 guidelines defects were concentrated in cash out refis, liability income defects were prevalent in refis, and the community lending segment has a very high level of owner-occupied transactions. So this time, let's take a closer look at some of the changes from Q4 to Q1. The first defect for income, it saw a minor jump for wage earners of 4%, which was only driven by 2 extra loans. And while defects related to self-employed borrowers went up by 145%, this included the COVID-19 temporary requirements, in addition to defects for income miscalculated or income docs missing. So the increase, again, was not surprising, as many of these loans were originated after June 11th, when the new self-employment requirements kicked in. So we saw a 100% decrease in missing or insufficient BK docs for investment in second home properties, which had 0 defects for those property types. It did, however, increase 75% in owner-occupied transactions, which contained all 14 defects this quarter. And third, our COVID temporary income defect saw an increase across all transaction types. You'll notice the percentages are high. However, it's important to remember that we started with very low number of defects in all 3 categories at 7, 4, and 2. In addition to the increase in number of loans we were funding, we also saw more loans subject to and impacted by the COVID-19 temporary guidelines. And lastly, missing or insufficient documentation to support liabilities actually went down 17% for our wage earners and self-employed. However, it increased 500% for people earning any other source of income. So the quick takeaways from this are, 1, we must remain vigilant on every loan. Try not to let any less risky business or strained resources impact quality, as we see defects can pop up anywhere. 2, continue to be aligned with the remaining COVID-19 temporary guidance, in particular the tightening around income requirements. And 3, defects related to income and liabilities remain high among all our seller servicers. So lastly, this slide shows the types of defects we see on investment properties and second homes. The leading defect for both these occupancy types remain the same quarter over quarter, with taxes and insurance missing and liability documents missing or insufficient. And while minimal, and it was only by 3 loans, income shifted slightly from miscalculated last quarter to documentation missing or insufficient this quarter. Again, remaining vigilant across all occupancy, income, and transaction types remains a top priority for an effective origination and quality control process. So here, I also wanted to take a quick moment for a QC PSA. Year to date, quality control has seen a 56% increase in our missing document rate, as well as a 43% increase in our appeals. we're issuing more repurchases, and a large amount of them are for missing or incomplete files. This puts additional touches on files, which further strains resources. So we do encourage you to take the full 30 days that we allot to deliver a file to ensure it is complete as possible. And we'll touch on loan file delivery in a future webinar. So now let's open it up for any questions you have on this topic.
We will now be taking questions. If you have a question, please enter it in the Q&A box located in the lower right-hand corner of your screen. Steve, we do have one question, and that question is, can clients see their missing docs?
Sure, that's a great question. So yes, we have a system called QCA, or what Freddie Mac refers to as Quality Control Advisor. And there is a tab within that called Management Reporting. Within that tab is a chevron for missing docs. So when you're in that chevron, you can see your missing doc rate, your missing doc response times, your trending of missing docs over time, and even your top 10 missing docs. And there's any of the blue view details. There's a little blue link at the bottom of each box that says view details, and it'll give you a list of all the missing docs for the selected time period. It'll include the comments QC provided, and it's exportable to Excel. So this is a great way to use our findings as feedback into your own process to improve quality.
Thanks for that, Steve. I don't see any further questions yet at this time.
Excellent. Well, then I'm going to hand it off to our QC managers. They're going to present some scenarios around adverse credit events. So George, take it away.
Thanks, Steve. Good afternoon, everyone. For our second topic, we will discuss two loan scenarios related to adverse credit events. We chose these scenarios because we received feedback from our sellers, as well as our own quality control and quality assurance teams, that these always present unique and difficult challenges. Also, as you saw on the defect trending, liabilities, income, and bankruptcy documentation are still top trending defects. These adverse credit events can touch on all three of these categories. First, we'll examine a loan scenario of mortgages included in bankruptcies. And later, Mike will evaluate another loan scenario of a borrower's credit for manual underwriting. So let's get started. In our first scenario, we have a purchase transaction of an owner-occupied single-family residence. The loan-to-value ratio is 80%, with a total debt payment to income ratio of 30%. The loan received a loan product advisor risk class of caution. The note date for our loan was October 1st, 2020. Credit risk comment messages reflected on the LPA certificate included the following. Bankruptcy/significant derogatory information appears on credit report. Analysis of credit history is recommended. Delinquency reported on accounts. Number of inquiries/high risk combined with other factors. High overall utilization of revolving credit adds risk. And finally, for mortgages not verified on the credit report, direct verification of payment history is required. A review of the credit report reflected a Chapter 7 bankruptcy that was filed in December of 2016 and discharged in May of 2017.
So George, don't we know right away that the loan is not eligible for delivery to Freddie Mac? Isn't the recovery period for a Chapter 7 bankruptcy 48 months from the discharge or dismissal date?
Good question, Mike. Per Guide Section 5202.5, the recovery period is 48 months when the significant adverse or derogatory information was caused by financial mismanagement. However, if it was caused by extenuating circumstances, then the recovery period is only 24 months. Now, this is a very high bar to meet. However, for this loan, the lender was able to provide sufficient documentation and justification to support extenuating circumstances existed. Therefore, the recovery period is acceptable.
Since they established the existence of an extenuating circumstance, then the loan would be acceptable?
Well, not necessarily. There's still more analysis that we have to do to determine the credit reputation is acceptable. When reviewing the file, the credit report did reflect the prior bankruptcy. Additionally, a mortgage trade line was reflected, with a history reporting through December 2016 that indicated as closed. The trade line included the following additional comments: bankruptcy Chapter 7, real estate mortgage, bankruptcy discharged. Further analysis of the credit report reflected 8 trade lines that were currently open and active, which included the following: an auto loan paid as agreed for 36 months, 2 student loans paid as agreed with a greater than 24-month history, 5 revolving accounts all paid as agreed with a greater than 12-month history. So all reestablished credit has been paid as agreed.
So the file documented extenuating circumstances so the bankruptcy recovery period was met, and the borrower has sufficiently reestablished their credit since the bankruptcy as evidenced by the credit report. It sounds like we now have a loan that is acceptable as a manually underwritten mortgage.
Well, unfortunately, there's still more documentation that is needed. Section 5202.5 of the guide also reflects the following additional requirements when a borrower has had a prior bankruptcy. And these are required regardless of whether the loan establishes extenuating circumstances or we are following the requirements for financial mismanagement. These requirements are whenever a borrower has had a bankruptcy within the last 7 years, the mortgage file must also contain copies of the bankruptcy petition, schedule of debts, and discharge or dismissal, evidence to indicate that all debts not satisfied by the bankruptcy have been paid or are being paid, any other evidence necessary to support the seller's determination that the borrower has established and maintained an acceptable credit reputation. In this case, the file did not contain the bankruptcy papers as required. The documentation is further needed to determine what occurred with the mortgage on the credit report that was indicated to be included in the bankruptcy.
Why would we need further documentation on that mortgage? The credit report confirmed the account was closed and that it was discharged as part of the bankruptcy. What else would you expect lenders to do when they see a mortgage included in bankruptcy?
That's another great question. Unfortunately, the credit report cannot be accepted as sufficient documentation to verify the final disposition of that mortgage. It still must be determined what became of the property that the mortgage was secured by, as there are several possible outcomes. These include the borrower could have retained the property and signed a reaffirmation agreement. The mortgage could have been discharged, but the borrower agreed to continue making payments, or they could have ceased making any payments. In the latter, the lender could have then foreclosed on the property or may have worked out a short sale. Given that the recovery timelines for these events differ, it is necessary to find out exactly what occurred with the property and document it accordingly.
So the end result is that the loan in this scenario is not acceptable due to insufficient documentation?
That's correct. In this case, a repurchase letter would be issued due to the insufficient documentation.
It seems that all we need are bankruptcy papers. If the lender provided those through the appeal process, we'd be able to rescind that repurchase.
That would be the first step. However, the providing of the bankruptcy papers alone may also not be sufficient. Let's see what happened in our scenario where the bankruptcy papers were in fact provided on appeal.
The papers did include the statement of intention that reflected the mortgage from the credit report and the property that it was secured by. It further reflected that the borrower intended to retain the property and enter into a reaffirmation agreement. A public record printout was also included, confirming that the property was still owned by the borrower. So now we know what happened to the property.
That's right. However, there's still one more thing that is needed. Going back to Guide Section 5202.5, we can see that in addition to needing the bankruptcy papers, we also need evidence to indicate that all debts not satisfied by the bankruptcy have been paid or are being paid. And this documentation is still missing. We now know that the borrower still owns the property, so we must document an acceptable pay history for the most recent 12 months for that mortgage, since it is no longer being reported on the credit report. Without this documentation, an acceptable credit reputation for the borrower has not been established, and the loan is still not acceptable for delivery to Freddie Mac.
Now that we know the final decision, what are some of the key takeaways from the scenario?
The first takeaway is that a mortgage debt reported as being included or discharged in a bankruptcy on the credit report does not prove that the debt was discharged. The discharge must be verified with the bankruptcy papers. Second, verification of the property disposition alone may also not be sufficient. Additional pay history documentation may also be required. And third, when a significant derogatory event is identified, be sure to reference Guide Section 5202.5. Now let's see if we have any questions from our audience related to our first scenario.
We will now be taking questions. If you do have a question, please enter it in the Q&A box located in the lower right-hand corner of your screen. Looks like we do have a question, and that question is, can you provide more insights as to why the credit report is not sufficient to verify that a mortgage was in fact discharged and closed through a bankruptcy?
That is a great question, and that is one of the main points that we wanted to emphasize with this scenario. From our example, we can see that there are times when a mortgage will no longer be reported to the credit bureaus after a bankruptcy or other significant derogatory event. Therefore, the credit report may not be reflecting the most recent and most accurate information relating to that obligation. That is why additional research is required to determine both the disposition of the property as well as the status of the mortgage in question. In our scenario, we know that the borrower retained the property, therefore the additional pay history documentation is required in order to verify an acceptable credit reputation. If the pay history is provided and verified no late payments, then the loan could have been accepted. However, if it did indicate recent late payments, then the credit reputation would not be acceptable.
All right, just seeing if there are any more questions coming in before we move on. Okay, what if AUS accept eligible bankruptcy reflects discharged on the credit report with no mortgage reflecting on the credit report?
So this is Steve. I'm just going to reread that question in my head. What if AUS accept eligible bankruptcy reflects discharge on the credit report with no mortgage reflecting on the credit report? So LPA, if you get an LPA accept eligible and it reads the credit report and it reflects that there is a mortgage, if it accurately assesses that there is a bankruptcy, and I'm trying to think, bankruptcy reflects discharged on the credit report with no mortgage reflecting. So if there is no mortgage and the LPA accepts it, there's no further documentation that you need at that point. You do not need to go provide the bankruptcy papers. I think that's what this question is asking me. You do not need to provide us the bankruptcy papers on an LPA accept if there's no mortgages. If there is a mortgage reflected on that credit report, then we would need to see the bankruptcy papers in order to determine the final disposition of that mortgage, because we have found over time that the credit report agencies they don't always report the proper status and final disposition of properties. That's just been our experience over the last at least the last 5 years. We found many times where it just was not reported accurately and that the borrower did either retain it without a reaffirmation agreement, just kind of a handshake with the bank to keep paying it, or that they have reaffirmed it indeed. And either of those situations would require an additional documentation potentially to make the loan eligible. So hopefully that did answer the question.
Okay, they did respond and said yes, that
Cool.
helped. So let's see, looks like we might have a few more questions coming in. Here, let me just. All right, the next question is, do we need the bankruptcy paperwork for 7 years from discharge, or LPA will waive that?
So again, I don't believe LPA specifically conditions. LPAs, I don't believe will specifically tell you if it does or doesn't need the bankruptcy papers. If you receive a caution, those loans are have to run through all of our manual guidelines. Our manually underwritten guidelines do require the bankruptcy papers. So any manually underwritten loan, bankruptcy papers are required. And again, I'll fall back to if LPA gave you an accept and it read the credit report and it saw there was a bankruptcy and you still got an accept, you do not necessarily need the bankruptcy papers unless there is debt on there, such as a mortgage, that you need to confirm the final disposition of that property. And that can be done through public records or closing disclosure or an affirmation agreement. We just have to know, was there a subsequent credit event or does the borrower still own the property? And do we need a payment history on that? Those are a couple of things we are looking for.
All right, it looks like we have one last question. The question is, doesn't a mortgage stop reporting once it's included in BK?
So I don't want to speak generally for different banks and different institutions will report it differently, but I think part of the problem is most times when it's included or at least it's identified in a bankruptcy, yes, we don't have any more history. It's not reported anymore. But again, what we found is many times borrowers retain these properties or retain them with a reaffirmation agreement. So you can retain it again with like a handshake deal with the bank. As long as you continue to pay it, they won't foreclose on the property or try to sell it. And then when you do a full reaffirmation agreement, you actually begin an entire new note with the bank essentially. So that's part of the problem is we don't get a full reporting after the bankruptcy as to what happened to the property attached that mortgage was attached to. So even if the borrower's obligation was extinguished through the bankruptcy, the borrower can continue paying it. That property may still could have a subsequent deed in lieu, a subsequent short sale. They might still own the property, and they can actually re-engage that through a reaffirmation agreement. They can re-engage their obligation to that property. So that is, again, why we always need the papers when a mortgage is involved, and that statement of intention becomes a critical document to verify where the final disposition of that property went to.
All right, thanks, Steve. At this time, we'll move on to the next section, and I'll turn the call over to Mike Zeman. Mike?
Hi, thank you. During our quality control reviews, we sometimes see loans that are reviewed as manually underwritten loans where the seller must determine if the borrower's credit reputation is acceptable. During the next few slides, we will show you one such example, and afterwards, we'll provide you some tips to help.
Mike, why don't we remind our audience of how Freddie Mac defines evaluating the borrower's credit reputation?
Great idea, George. This is an excerpt from the guide. As you can see, for manually underwritten loans, the seller must determine that each borrower individually and that all borrowers collectively must have acceptable credit reputations. In this scenario, we have a loan submitted with Loan Product Advisor with a risk class of caution. As you can see here, there are some important excerpts from the LPA feedback messaging. It shows that the LPA risk class returned a caution rating. In evaluating the borrower's credit reputation, we would always review the credit and liabilities messaging provided in the LPA feedback. The feedback messaging here shows several messages indicating a mortgage delinquency such as delinquency/derogatory on mortgage delinquency appears on credit, and time since delinquency is too recent or unknown.
There's a lot of messaging provided. How would we interpret all of these?
Another great question, George. In this case, we would reference guide section 5202.5 to gain additional guidance to better interpret the credit messaging. In this case, we would have to identify the adverse credit and then determine whether the derogatory information is significant. In this scenario, the borrower is refinancing their current home at 123 Street, which has their current mortgage reporting perfect payment history. When we look further on the credit report, we find a trade line that shows a different mortgage that has a history of being 120 days delinquent dating back to January 2016. In this case, we know the mortgage that we are refinancing is not the same mortgage as the mortgage that is showing 120 days delinquent. A property search provided in the loan file shows that the mortgage attached to our subject property at 123 Street is the same as the one that we are paying off.
So, are there other documents that we should review to help us get a better idea about this delinquent mortgage?
Another great question, George. The final loan application should be reviewed to see if there were additional addresses listed, and also the customer's declaration should be reviewed. In this case, the address is the same, 123 Street, and no previous addresses within the past 2 years. The declarations also show that the borrower declared not to have any outstanding judgments, no declared bankruptcies, foreclosures, or obligated directly or indirectly to any loans that would result in foreclosure, deed in lieu, or judgment against the borrower.
Well, something doesn't add up. If the borrower has a delinquent mortgage listed on their credit report, but they are stating they have never had any judgments, bankruptcies, or foreclosures.
That's exactly what our underwriter asked themselves. This was another red flag. There was nothing included in the file to explain the delinquent mortgage on credit.
So we issue Repurchase?
Yes, this file did not contain an explanation or meet the documentation requirements outlined for manually underwritten mortgages. In this case, the borrower has not established an acceptable credit reputation, and in this situation, the seller must presume the derogatory information is significant.
So that's all?
No, there's more. The lender appealed the repurchase. After receiving our repurchase letter, the seller was able to convince the borrower to provide additional documentation to explain the delinquent mortgage that was appearing on the borrower's credit report. We received a separation and settlement agreement from the borrower's ex-spouse, which outlines that the previous marital residence was awarded to the ex-spouse and the borrower was not liable for any judgments or liens after August 2012. As we reviewed earlier, the mortgage started showing 120 days delinquent January 2016. Since our borrower was relieved of all liability of the previous marital property, including the mortgage, in August 2012, the delinquency that started in 2016 should not be considered in our analysis when determining the borrower's credit reputation is acceptable.
So it sounds like the lender addressed all the issues that were cited in our repurchase letter. Were we able to rescind that repurchase?
In this situation, yes. The only delinquent event that was reporting against our customer was the ex-spouse's mortgage. The borrower had answered all the declarations correctly, and the rest of the borrower's credit met guidelines section 5202.5.
So what's the overall takeaways here for our audience?
Some of the takeaways: always review the loan product advisor credit messaging. 2, review the credit requirements outlined in guide section 5202. The messaging on the LPA is referenced in the guide and will provide you guidance on whether the borrower's credit reputation is acceptable. And 3, always investigate red flags. In this case, the borrower did not have previous residences. The only derogatory found was the mortgage that was seriously delinquent, and the borrower's declaration stated they did not have any significant credit events, foreclosure, bankruptcy, or judgments.
Those are great points. Now let's see if our audience has any questions.
We'll now be taking questions. If you do have a question, please enter it into the Q&A box located in the lower right-hand corner of your screen. We do have a question. Let's see. The question is, to be safe, should we always ask for a LOX for any mortgage late within 7 years?
So this is Steve again. That's a great question. So I would first say look at your LPA. In this case, let's remember the LPA returned a risk rating of caution, and all of those must go through all of our manual underwriting guidelines. So again, you have to, at that point, you have to address if there's significant derogatory events or significant derogatory credit. It must be addressed that way. If you have an LPA accept and it has read the credit and LPA has read the credit report, you get rep and warrant relief from the credit. So you are not required to do anything regarding any lates, be it revolving mortgage, installment. Only when it's not an LPA accept, should you definitely be addressing, supporting, and documenting the borrower's acceptable credit reputation.
Thanks, Steve. Looks like there are no further questions. So with that, I will turn the call over to Kelly Morocco. Kelly?
Hi again. Thank you for attending today's presentation on Affordable Second. Today, we will be discussing sources of Affordable Second, requirements for the participation and appreciation, mortgages with affordable seconds that are used to subsidize the purchase price of resale restricted properties, the accessibility of our revised affordable seconds checklist, and investor featured identifiers. We call them IFIs. Lots to unpack here. So with that, Susan, please take it away.
Thanks, Kelly. It's great to be here with all of you. Until recently, the source of the affordable second was not available to a property seller or an interested party to the transaction. We revised our requirements to allow nonprofit or government agencies that are the property seller of an income-based resale restricted property to be the source of an affordable second. We also allow seller-funded affordable seconds. These requirements were effective for mortgages delivered on or after March 1st of 2020. Since that time, we have had significant interest in these flexibilities and wanted to give you the details today. Let's start with seller-funded affordable seconds. And let me clarify, when I say seller, I'm referring to our clients who are the sellers of mortgages to Freddie Mac. The seller-funded affordable second is available to sellers who meet specific criteria, specifically that the seller must be a depository institution and have an established affordable seconds program that supports the Community Reinvestment Act mandates. The seller may not be the source of an affordable second that includes participation in appreciation. The seller-funded affordable second has certain requirements. It must not be funded through the first lien mortgage transaction. It may be forgivable or repayable and may be used toward the minimum down payment requirement. It must also meet all of the other requirements in Guide Section 4204.2 for affordable seconds. The first lien mortgage, which is the mortgage being delivered to Freddie Mac, must be a purchase transaction of a one-unit primary residence, must be a home possible mortgage, and must be a retail mortgage. In some specific instances, the property seller may be an acceptable source of an affordable second, specifically when the property seller is either a government agency or a nonprofit entity, and the property is subject to income-based resale restrictions. Affordable seconds from the property seller are permitted in two circumstances for income-based resale restricted properties. The first is that the property seller may be a government agency or a nonprofit entity that acts as the program administrator for the government agency. The nonprofit entity may also act as the property seller on behalf of the government agency. In the second instance, the source of the affordable second may be a nonprofit entity that is also the property seller, but is not affiliated with the government agency. However, in this case, the seller must first obtain Freddie Mac's prior written approval to sell the related first lien mortgages to Freddie Mac by contacting the seller's Freddie Mac representative or the customer support center at 1-800-FREDDIE. A good example of this type of transaction could be an organization like Habitat for Humanity, who is the property seller and provider of the affordable second. These requirements allowing a property seller to be the source of an affordable second, as well as allowing a seller-funded affordable second, went into effect on March 1st of 2020, the same time that the new IFIs were implemented. As a reminder, Freddie Mac buys only the first lien mortgage and not the second mortgage. Hey, Kelly, would you like to review our next topic around participation and appreciation, which is also known as equity sharing?
Absolutely. Thanks, Susan. When we revised the section of the guide in March of 2020, we wanted to make it clear who could participate in appreciation or equity sharing. We did this by adding the term subsidy provider as a party who can share in appreciation. We also clarified that for-profit entities may not share in appreciation. So, subsidy providers can share in appreciation, for-profit entities may not. We received feedback from both sellers and subsidy providers that our requirements for participation in appreciation were such that subsidy providers did not think that their programs would fit our requirements. After much research and in an effort to appeal to providers of affordable housing programs, we made the decision to change our requirements so that it would allow subsidy providers or program administrators managing income-based resale restricted programs to participate in appreciation. We modified the terms allowing equity sharing when an affordable second exceeds the percentage of an affordable second. And as you can see on the slide, there is an example of a standard requirement. The example here tells the story. For example, if you have a 90% first lien mortgage and a 10% affordable second, it would mean that the equity sharing to the provider is limited to 10%. Not many programs would meet this requirement, so we made modifications as shown on the next slide. This is where it gets a little tricky. So when equity sharing to the subsidy provider exceeds the percentage of the affordable second, there is an exception, but only if the following requirements are met. You'll see that the first requirement did not change except for we added the term subsidy provider. Prior to the most recent revisions, the agency's share of appreciation was limited to 75%. We have now added a provision that would not restrict the percentage of appreciation if the provider of the affordable second is a subsidy provider or program administrator managing an income-based resale restricted program, and the seller confirms that all of the special requirements for mortgages secured by properties subject to income-based resale restrictions in section 4406.2 are met, and the subsidy provider or program administrator has processes in place to allow the borrower to receive a share of the proceeds of subsequent sales in instances where the subsidized resale price of the property increases at resale. This slide highlights the requirements that protect the borrower's investment in the program. The terms of the affordable second must allow the borrower to recover all of the following before the agency or subsidy provider is able to share in appreciation. This includes down payment paid by the borrower funds, customary costs incurred by the borrower for selling the property, and the payment of the first lien mortgage. In March of 2020, we introduced requirements specifically for our affordable seconds to be used by affordable housing program providers as a means to subsidize the sale price of a property. As a result, the program may impose income-based resale restrictions. The difference between the market value and the resale restricted price represents the subsidy amount secured by the affordable second. So in this example, $300,000 is the market value and $200,000 is the restricted sales price. The difference between the two is $100,000, which is the subsidy amount that is being provided by the affordable housing program provider. The typical terms of this type of affordable second include either no payment or deferred payment, and the entire balance may be forgiven at some point in time in the future. Please note that resale restrictions may not restrict Freddie Mac from sale or transfer of the property once Freddie Mac acquired the title to the property as an REO. Susan, is there an easy way to review whether secondary financing might meet the qualifications of an affordable second?
There sure is, Kelly. We've included a link to our checklist for affordable seconds in the guide, section 4204.2, for quick and easy access. The checklist helps to create a clear path for understanding what does and does not qualify as an affordable second. This wraps up the policy portion of affordable seconds, but before we move on to the next topic, let's cover the key takeaways. We discussed 2 new sources of affordable seconds, which include seller-funded affordable seconds for sellers that are depository institutions and have programs established to meet CRA mandates, and nonprofit entities that are not affiliated with the government agency. Remember, these need a negotiated term of business. We added 2 new IFIs for the new sources of affordable seconds. We revised the requirements for participation and appreciation that will line up better with affordable housing programs. We discussed a type of affordable second that is used to subsidize the sales price and create a lien against the property. And we have revised the affordable seconds checklist and placed a link in the guide. For our final topic, I'll discuss affordable seconds and differences between the data entry in Loan Product Advisor and Loan Selling Advisor. We have had a lot of questions from our sellers regarding the correct way to enter an affordable second into Loan Product Advisor, as well as the correct way to deliver the loan when it has an affordable second. Today, we'll provide some tips that may address some of your questions on this topic. When you're reviewing a loan file, it's necessary to determine what type of secondary financing is involved in the transaction. One way to get an idea of whether you have an affordable second is to check who is funding the secondary financing. If it's a government agency or a nonprofit, it is likely an affordable second. Your file should contain the terms of secondary financing so that you can compare this to the affordable seconds requirements outlined in our guide. After reviewing the terms of the secondary financing, you may have concluded that you have an affordable second that meets Freddie Mac's requirements. Let's take a look at the last bullet on this slide. Does the affordable second require a payment before the due date of the 61st monthly payment? This is an important point to answer, as the answer to this question will determine how the affordable second should have been entered into Loan Product Advisor. If you're using Loan Product Advisor version 5.0.06 or higher, the terms of the affordable second must be entered into the Other New Mortgage Loans on the property you are buying or refinancing section. The monthly payment field should show 0, and the Yes buttons should have been selected to indicate that it is an affordable second and the payment on the affordable second is deferred. On the next slide, we'll see what this looks like. Here's what those fields will look like if they've been completed correctly. If the payment on the affordable second is not deferred, it's critical that the monthly payment for the affordable second field has been completed accurately and that the answer to the question about whether the affordable payment is deferred is no. On the next slide, we'll see what that looks like. Here's what those fields in Loan Product Advisor will look like when you complete those inputs. In summary, there are 2 different ways that affordable seconds could be entered into Loan Product Advisor. One way if the affordable second has deferred payments, and a different way if it does not. Making sure that the loan has been entered correctly is critical in ensuring that the affordable second is treated properly where the repayment is concerned. I think that's a wrap, Kelly. It was great being here with all of you today, and we appreciate your time as we reviewed the recent changes in affordable seconds. Now let's open it up for questions.
We will now be taking questions. If you do have a question, please enter it into the Q&A box located in the lower right-hand corner of your screen. All right, I don't see any questions at this time. So with that, I'll turn the call over to George Karenchak. George?
Thanks. As a reminder, for additional information, we encourage you to take advantage of the training and resources available from the Freddie Mac Learning Center. The customer call center provides seller servicer support Monday through Friday at 1-800-FREDDIE.
And please visit Freddie Mac's single-family website at sffreddiemac.com and stay current with resources there, including the single-family seller servicer guide at guide.freddiemac.com. You may also find additional guidance and information, including the recordings of our Let's QC webinars, on the single-family quality control page hyperlink above. And lastly, for more information on duty to serve, please visit freddiemac.com/about/duty to serve /.
Well, that ends our portion of the presentation today. We hope you've enjoyed this webinar and that you found it useful. Steve, do you have any final words?
Yes, I want to thank all of our clients who joined us today for this call and let you know that we appreciate your business. Now you're going to see a short 4-question survey on your screen. We appreciate your responses to these questions so we can continue to improve and provide valuable information on these Let's QC quarterly calls. Thank you all and enjoy the rest of your day.
As a reminder, the recording and supporting resources will be made available on the QC webpage. Enjoy the rest of your day.